Here's the question. How much should life insurance cost in a perfect world? When do you underpay? When do you overpay? And if the insurance company can't have reserves, it's actually the people paying for the benefit. So let me show you an example of what I mean when we couple an actuary table of when people pass away and what we call a decreasing pool. Many times we forget that there's a decreasing pool. Let me show you what I mean. Let's assume we have a bunch of 40-year-olds. We have 1,000 40-year-olds, and they each get insurance for $1,000. So now, when these 40-year-olds pass away, the aggregate risk for the insurance company is $1 million. Now, we're not accounting administrative fees or marketing, anything like that, just money in, money out. So the question is, when does this $1 million get paid out? And when does it get brought in? So let's assume there is a 1% passing away at age 40. That's easy to calculate. 1% of 1,000 or minus 10 people. So you pay out $10,000. $10,000 gets paid out. We figure out the premium, and the premium looks like this. You got 1,000 people, got to get $10,000. The premium these guys got to pay is $10 per year in year one. That's it. Now, the next year, let's assume the death rate goes up a little bit. So we're going to assume 1.01 is the death rate in year two. Well, if the death rate is 1.01, what we do is we take 990, the amount of people in the pool, we divide that by 1.01, or we multiply by 1.01, and we get another minus 10 people. At minus 10, we figure out what does this cost. Well, 990 people minus 10. Now they're going to pay about $10 plus a little bit. $10.10, something like that. So the risk of dying at age 40 or 41 is very, very, very similar. So the cost of insurance does not go up very much. But everybody's made whole. The 10 widows get their payout, and the people paying in get what they're paying in. Now, in reality, you get different coverages and different ages, but we're assuming 1,000 40-year-olds here. But when we fast forward to age 75, and we say, well, the cost of insurance is going to be higher for two reasons. People are dying quicker, and the pool is smaller. So, for example, when I look at this, when we look at a 75-year-old, we say, well, now there's 500 people left in the pool. And at 75, hypothetically, you have 10% of people passing away. Now you have 50 people passing away. So your payment is going to be $50K. So you owe $50K from the 500 people. So now you say, well, at that age, how much are they going to pay? If there's 500 of them and they owe $50,000, now their premium is $100 per year. So the 75-year-old pays 10 times with the 40-year-old because there's less people paying, and there's, of course, more people dying. And this goes on, and when we go back to about 99 years old, and we figure, okay, there's one guy left in the pool, and the pool, if there's one guy left, that means 999 people have passed away. And this insurance program has paid out $990,000. And what is the last guy's premium? This is the question about insurance. Well, his premium, if one guy dies and he owes $1,000, his premium is going to be $1,000 per year. And in his last year of insurance, he's going to pay as much as he gets. And so if you hold yearly renewable term or term insurance all the way till age 100, it's likely you might overpay. But if you hold life insurance and you are very young and you just say, well, I'm going to hold it just in the earlier years, you might underpay. Or you may pay exactly what it's worth, but it's a risk you can't really take. And so this is how 1,000 people, if they were to get together and buy an insurance policy, for $1,000. They didn't use a reserve, they didn't use interest rates, they didn't use future value of money, they didn't use velocity banking, and different financial instruments. You end up in a situation where the younger person underpays, the older person overpays, and there's really three types of people in a policy. There's the person who buys it and dies, buys it and keeps on paying, and the guy who buys it and cancels. And when you buy insurance, it has to be fair to all three, including the company that's doing the insurance. Everybody has a chance to win when it's done properly.